Hey, what's up, guys? It's been a minute since I made one of these. Sorry, I've been, pretty much down and out with COVID, and then we had the holidays before that. So I'm a little bit better on the COVID end. I think I'll be 100% by January, hopefully. Just still kind of have like shortness of breath, really. So if any of you guys or family members, are out there that have it and stuff, I hope you guys have a speedy recovery and we get through this. But, it sucks getting it. So anyways, moving on. So this video is going to be about SPACs, and the one I've been posting about how to write this down because it is hard to say his name. It's Chatmith Palihapitiya. Okay, he's the CEO of a company called Social Capital. So if you see me post on my stories, so if you watch my stories every day or just glance through them, you'll know that that's where I just put out some content that I don't always post, right? Anyways, what he so Social Capital took made public these SPACs, and I'm sure you heard this SPAC, SPAC, SPAC everywhere. And of course, everything I say today, please do your own DD, do your own due diligence, use Google, use Wiki, use Investopedia.com, do your own research. This is just what I have. Everything I'm about to say right now is my own opinion. It's there's risk in the stock market, guys, and the ultimate risk is losing everything that you put in, right? So you need to do your own homework. But so this is what an SPAC is. It's called a special purpose acquisition company. So in what's that mean in English? It's essentially a shell company. So what these guys do is they'll say, okay, we're going to make this SPAC. It's going to be called, IPO, like Chatmith, or he has IPO B, C, D, E, and F. So let's use B, for example. If you would have invested in IPO B, it was trading at like $12. So the par value, you saw me put up the SEC or SEC form for the person that owns Open. He got the stock at, $10 a share. We're never going to get it at that price. When these SPACs hit the market, people drive the value up. And every SPAC is different based on valuation or whatever, but each one of these SPACs is trading at like 20% of a premium value, right? So what does that mean? That means like they have, like, let's say they raised $1 billion, right? So I get a bunch of people together, say, hey guys, I'm going to go and take a private company public. Let's use Subway, for example. Let's say IPO, well, C's done because it's going after Clover, but let's say IPO D goes to Subway and says, hey, instead of you going through the whole IPO roadhouse, right? So let me take a step back and explain the difference between this. So when a company originally IPOs, they'll file with the SEC. They'll say, hey, this is who we are. Here's our, balance statements, our due diligence, or, everything that we need to file with them. The SEC combs through it, make sure everything's on the up and up. It's a very scrutinous process, because they're bringing it to the public, and we could talk all the mess we want, but the SEC is set up for to protect the public. Now, to do that, like I said, we could talk all the mess we want, but it is a very strenuous process. It's not easy to IPO. Once the company says, okay, we're going to go public, then traditionally most companies would pick an investment bank. And an SPAC is going to kind of act like that investment bank, so I'll get into it a little bit more. But a traditional route would say, okay, so let's say Subway went to the SEC, they filed, and then they said, okay, we're going to take Subway public. They say, okay, give us all your financials, your assets, everything you got. Okay, great, you're good. Then they would then Subway would go pick like Merrill Lynch or, Goldman Sachs or, fill in the blank, one of these big guys, these big dogs, because they're for their connections, right? So then what you have is you have a roadshow. A roadshow is what they call it. They get the CEO together, the CFO, all the heads, and they start going to all these institutions and they start saying, hey, we're about to take, like Airbnb just did it. We're about to take Airbnb public. For our example, we're using Subway. We're going to take Subway public. And, maybe I'm like CalPERS, which is the biggest pension fund in California. And I'll take a meeting and say, you know what, we'll allocate a 10 million, we'll allocate 100 million, depending on whatever the evaluation is. You show us a pitch, you say what you could raise. And that roadshow kind of starts determining what the value of that company is going to be, right? And I'll talk about this more into the SPACs. And then so what happens is let's say Subway was gonna give an initial public offer of $1 billion, but they hit the road and everyone's like, oh, I'm gonna gobble up these shares. We love Subway. We'd love to invest. And let's say they end up raising like $500 million, right, from the roadshow. Now they're like, oh, we only got to raise $500 million from the public. Now we could bump their share price up, and these shares get issued out that time. So there's a bunch of other stuff. There's dilution. There's as more shares come on board, your shares become less valuable. But in the long term, that capital you're hoping goes into the business. They use it correctly, and it doesn't matter. You go to the moon, right? So that's the traditional way to do it. And eventually, after the roadshow's done and they've sold their stock to all these institutions, then they set up a day. Okay, we're gonna trade public on the NASDAQ on January 10th or 15th or whatever day it is. So that everyone gets hyped up, and you get the press and the media and the Jim Cramers of the world, and I guess people like me, like, hey guys, watch out, this company's gonna go public, right? And then they'll list like on the NASDAQ or one of the exchanges, and so all the institutional investors already have their piece of the pie. Then the company holds, and the company, their CEOs has their shares, their CFOs, their original investors, their employees, and then the company will issue another, let's say like 10 million or 20 million shares. And that's what suckers like me and you are going to buy, right? We're going to fucking, hype it up even more. We'll buy it to the moon. And then it comes back to reality. Then it just kind of, or it never comes back to reality. Some of them, like you look at quantum space, it's trading at $130, and 2 weeks ago you could have bought it at 13. It's crazy. So that's the original way to do it. So what's an SPAC? What does an SPAC do? Essentially, the SPAC, let's say for Chamath, for example, he is using let's use IPO-D because that's a blank check right now. So he'll say, okay, guys, he'll still go to the institutional investors at first. So he's going to go to a bunch of people that got a lot of money to say, okay, I need 500 million, and I'm going to open SPAC, a special purpose acquisition company. It's a shell company. So all these other people, they'll list, $500 million, and they'll divvy up the stock. And then they'll file with the SEC. And this is what the weird part is. The SEC doesn't do as much due diligence as if a company were to go straight to the public, right? So the SEC is going to say, okay, we'll allow you to list your SPAC on the exchange. There's a bunch of terms. You got to do your own research on it. But there's a certain amount of time that you have to acquire a company. There's a lot of things you have to do. But essentially what happens then is, they say, okay, cool, we're going to list. Then they'll list on the New York Stock Exchange or one of the many exchanges, right? It's not always, there's not always just one exchange, but usually the NASDAQ for these bigger SPACs, that's where they're going to list. So then people like me and you, retail investors, now we become, in a sense, the institutional investors, right? So when the SPAC lists, on the exchange, it's doing a roadshow. But the weird part is we have, and the risk is you have no idea who that company is going to merge with. You're just literally throwing money at the wall and saying, let me see what happens. Now, Chamath, I trust him. The dude's a G. His investing, just look at his history. He's going to make you money. But again, my opinion, you got to do your own research. So, something that it's only worth 500 million in cash on the exchange will trade at 600 or 700 million. As you can see, it's trading 20-30% above what it's worth. It's only worth 500 million. They only have 500 million in cash, but it's trading at a lot higher. So then what happens is this company will go out and say, so let's use Subway, for example. This company will go out and say, hey, instead of Subway, they'll approach a bunch of other companies and say, hey, Subway, I heard you're interested in going public. Subway's like, yeah, man, but, we're kind of nervous about the roadshow and the IPO. I'm like, hey, don't worry about it. This is what we'll do. We'll take your company directly public and, let us do all the research, and we'll negotiate a price with you. So then what happens is Subway says, okay, wow, you're going to give us, $500 million? Yeah, I got 500 million. Okay, you're going to give me 500 million? Yeah. What are we going to get returned for the SPAC? Well, they'll say, okay, well, how about we give you 10% or 20% of Subway, and then we'll go directly to the market. And so if you own, that SPAC IPO, let's say D, for example, then that $500 million in cash is going to purchase 10%, 20% of a company. Like for Subway, let's say you would give Subway 500 million, you'd get 10% of Subway, and then your ticker symbol, IPOD is going to switch to, S-Way, for, let's just say for Subway, whatever the ticker is going to be. Then that company, on this date and time, when the deal's done and everything's on, the gentlemen shake hands and it'll get listed. Then it's available to the public, right? But you, as a shareholder of IPO like D, for example, and I'm using IPO D because it's one of the SPAC. There's hundreds. Literally, Google SPACs I should buy or SPACs coming out. You can see who's what, what's what. It's the craziest wave right now. But essentially, then you would, by owning that, you got early access to Subway stock. If you bought the SPAC at $12, when it gets listed, maybe Subway gets valued at $20 or $25, right? So you became that institutional investor. Then, when Subway actually hits the market, it'll start trading, and it takes time for all the brokerages to align and get the ticker right. Then Subway could go out to the public and issue even more shares. So that's where the dilution comes. So an example of this was DraftKings, right? DraftKings went public through Eagle, and Eagle was at like $9 or $10. I mean, that thing just ripped up to $30. And then you saw DraftKings was a good business. It still is a good business. And then you saw it go all the way to 65 and even 40. And then you saw at different points, the company would issue more stock to raise capital, right? And the stock price would, go down because they're issuing more shares, but now it's settled out. And so that's one of the things you have to realize with an SPAC is when you buy one of these SPACs, you're not buying 100% of the company they're merging with. You're getting a good percentage of the company, but you're helping bring it public, and essentially you're getting early access to shares of a company. And the dangerous part is the risk is, remember, you get paid in direct correlation with the risk you take in markets. So here's the risk. If you buy, let's say IPOD, it's trading at like 12 or 13 bucks. You're like, damn, it's only worth 10. It literally is only worth 10, right? It's trading at 20, 30% premium. And you don't even know who they're merging with. But then once the news gets announced, like, oh, they're going to merge with this new high-flying company, then some of the younger people that are on the game that know, they're like, oh shit, we better buy this. Then that stock's going to go to 17, 18. Now you got paid for that risk. And then when it goes public, it might go to 20, 30. Now you really got paid for that risk. The downside is it's going to go to 10 because then the company just sells out and they redistribute all the investors' money. So you really can only lose, 20, 30% of whatever you're putting in. You're only guaranteed to lose that, but the upside is so high. I like IPO, C, D, E, and F because I trust Chopmith, and I think he knows what, I believe that he knows what he's doing. So, and I'm going to watch it closely, and you always should, run your stop losses and everything like that. But this is what I'm posting about. And you guys already know, I'm going to bang the table on this. I'm really high on the score, and I'm really high on Doc RF, which is the medical company, tele company for Canada. Those are two cheap stocks. But for these SPACs, there is a lot of risk, guys. And, I don't want to see anyone get hurt. I post this information, but I always post with it, do your homework. You can make a lot of money, but you could also lose 20 or 30%, 40% of your position. So if this is something that's up for your appetite, if this is something that you're willing to risk, then I would say go for it. And I hope this kind of clears up what the SPACs are. So C, D, E, and F. C is merging with Clover. You have D, E, and F. Who knows what they're going to merge with? You're paying a premium, and I would say strap in and hold on, and let's see where it goes. But those are the major difference between an SPAC. An SPAC literally is buying a portion. It's a blank check shell company, and they're going to buy a small portion, or not a small, it's a pretty big portion, right? Anywhere from 10 to 20 to sometimes 30% of a private company, and they're going to bring it public. And you are getting paid for taking that risk of seeing what company is going to take what public. So, happy hunting, I guess, So if you have any questions, please drop it in the comment. I know you guys have been DMing me. That's why I made this video. Drop it in the comment, because if you have a question, I guarantee you someone else has it. And if I don't know the answer, I'll tell you I don't know. I'll go Google it. I'll do the research. I'll help out as much as I can. Maybe even someone else could jump in. I don't know everything, I'm learning just like you guys. So, good luck, and I hope this cleared up a lot of your guys' questions.